So you good? Oh, can you guys hear me? Just let me know in the chat if you can hear me. And if you can see the screen, just let me know. What's up, Kaiser, Hasnat, Hannah? Yes, you can. Yes, and you can see the screen. All right, cool, great. We'll just wait for a few more guys. Morning, Tony. Yeah, I'm good, brother. It's been a while. Haven't seen you in quite a while. Salam, Zavi. You guys all good? If you have any questions you wanted answers to, you can post them in the chat. Right, so it's yeah, we can go through some stuff, Tony. We can go through some stuff on the crypto side. No, not a problem. The Discord's always open. Right, so there's quite a few things that I've been doing inside the Discord together with a couple of guys. And for the last month or two, we've been tracking and trying to look at something specific. And I'm going to do this a bit ass about face, upside down, where I'm going to give you guys the second half of the topic that I want to talk about, and reserve the first half for the 2 Degrees live stream that I'm doing on Wednesday this week. It's just because there's some stuff that I can't talk about on the 2 Degrees stream, some indicators that I can't use, so I'd rather have you guys watch this second part, so to speak, first. So we're doing a prequel movie here first, and then on Wednesday we'll get into the simpler stuff. Yeah, I still use 9 to 9:15. Not as often, but I still use it, Tony. So I just need to pull up one of my profiles here on NQ, whatever I'm talking about here is universal. It applies to every and all assets. So there's nothing specific to NQ or ES that I'm going to talk about. If you guys caught any of my tweets or anything last week, you would have seen that what's up, Divakar? You would have seen that I caught about 1,000 points in NQ on Friday, right? And that wasn't by accident or fluke. I could have caught more than that. My first short on NQ came in. Let's take a look here, right? My first shot in the AM session, that is, came in right here, and I'm going to show you why that's the case and what the target was. So if it hasn't been apparent or clear to anyone or a lot of you guys, we don't ever long at the top of a consolidation, and we don't ever short at the bottom of a consolidation. So what that really means is that whenever we get a consolidation, our job mainly is to, if in trend or bearish trend, we're going to look for shorts at the consolidation highs and longs at the consolidation lows. So what happened here in particular, I shorted this consolidation. Let me just see if I can draw it up for you. There's a consolidation low we made here to a high. And what I did here, and you guys are going to see a lot of this, is when we approached the CE of this wick right here, so this high to that low, there's your CE here, consequent encroachment of this wick. So as close to the consolidation high as possible, I shorted here and put my stop a little bit a ways above. And this was just confirmation here. Now the draw was around 24,440-ish, right here. This was the draw. So in essence, what this trade actually was or would have looked like is, let's just get a short tool here. Right, somewhere around 20 points, and the draw was around 23,440-ish, 23,404, I think. Right there. That was the first short. I closed that short down here when we had this MSS, and inside my group I posted something a bit cheeky. Like I'm assuming or making an assumption here that most of you guys have watched my flash and zoom models. You understand what flash is, you understand what zoom is. It's going to be a very vital part of what we're doing here, especially on Wednesday when we get into the standard deviations. So this range here was what I call a flash range, and if you notice, it's also a consolidation high here. The previous OB range, when price approached this low, this was the previous OB range, and if price is still heading lower, then yeah, that's good, Kaiser. All right, cool. So what I did was we hammer as price approaches these highs here, right? Let me just get the hammer the right side around, right there. And that's again going with the same idea that we don't long at consolidation highs and we don't short at consolidation lows unless there's some kind of retracement or pullback, right? So if this is a consolidation high, previous OB range, you short again here, and then this short had the same target, And I posted all of these on Twitter, right? I'm looking for another 300-400 points lower, and same idea right here. And you can see how this guy worked out. Right now, believe it or not, the ideas for, or the ideas for where these should end come from using EMAs. Right, I never thought there'll be a day where I even include or incorporate any EMAs, but this actually ended up being one of the what do you call it? One of the confirmations or keys to understanding where delivery should go to. So on any time frame that you are on, if I'm looking for specific targets or specific areas to either reverse from or go to, the EMAs become your draws. So what that means is, at this point down up here, before all of this shit happened, once we get through here, this becomes your first port of call. Yeah, it will be uploaded, Hannah. So this becomes your first port of call, and once we start breaking through here, this becomes your second port of call, the EMA below it. You can see that's where I took my short, and then once we get below that, then we're talking about looking at EMAs that are further down the line. I'm not sure what happened to the one EMA, maybe I left it out, but that EMA was sitting somewhere around here, right? Now, if we look at, I'm going to show you, most of you are aware of Dexter fibs, right? You understand what a Dexter fib is? You've used a Dexter fib before? You know how to plot a Dexter fib. I call it Dexter fib because he popularized those fibs. What I'm going to show you between today and Wednesday is how to master those fibs. So, yeah. So, about 2 weeks ago, yeah, after OLR leg is the common fibbing, right? Of the OLR leg. So that's the common fib. But I want to get you guys into changing that a bit, because price isn't as static as you think it is. So last week, what I did was I posted that BTC is going to 125K. And when I posted that, or at the time that I posted that, BTC was about 108, 109, somewhere here. And I said 125K loading. Now you can see with the fibs that I use here on the, here, there's two deliveries being used here. I'm not just using an OLR leg of some sort and then projecting that to get some kind of deviation, right? We're not doing that. We're doing things slightly differently, and I'll get more into detail on Wednesday. But what I want you to understand is that flash and zoom are the essential or the foundation for every delivery that you take. Because what we understand is that when a delivery takes place, or what you're going to see on Wednesday is when we move from a market maker buy model to a market maker sell model, or vice versa, that those market maker models, if you don't understand that yet, cannot occur if we don't have a zoom model. And the zoom model means you have an OLR leg, or a leg that manipulates above a high. And the other case is if we have a flash model, which makes a high, then a lower high, and then a lower low, right? So a market maker model cannot begin or end without a flash or a zoom model occurring. Does that make sense? Which means every time you're between a delivery, you need a flash or a zoom model to occur, and everything in between the next flash or zoom model occurring. Are you guys still there? Just give me some ones in the chat so I know I'm not talking to myself here. What's up, Expo? Is everything still good on the screen there, Expo? I forgot to put the delay off. So what that means, if everyone's good, one's in the chat, okay, cool. So what that means is everything from your first zoom or flash model or market maker buy model to sell model or sell model to buy model, everything or every piece of price action in between should not want to close below a previous down candle body range before moving higher. You'll see that it keeps structure, it moves higher, and only when price starts to close in a market maker buy model below the low of a previous down candle range, that we know price has moved from a market maker buy model to market maker sell model, right? That's core understanding. I'll get more into it on Wednesday. But what I want to talk to you guys about here is understanding that price just doesn't move the way we want from one point to the other, right? There's a sequence of events that need to occur. Yeah, there is a 20-second delay. I wasn't sure how to take that delay out without ending the stream according to ChatGPT, so we're just gonna have to live with that for now, and on the next one just keep that in mind. So if you look here on how I fibbed BTC, right, with the understanding that I'm gonna show you this now and talk to you more about it on Wednesday, but the understanding that if I can find a zoom model, right, that's a market maker, this would be a zoom on a market maker sell model, and this would be a zoom on a market maker buy model. If I can find one of these two, or I can find a flash, right, then I'm able to fib those two deliveries and figure out where price needs to head to and why. So in this case down here, if I find a flash or a zoom, I can fib either or. In this case, the first delivery came off of this time frame here. We'll get into the time frames and why. Where we had, let's zoom in there. We had this, right? We had a low, a high, high low, and a high high, right? If I can spot something like that, or I can spot an OLR, the main thing I need to take away from either an OLR or zoom model or a flash model is that we need to start seeing expansion occur after we've chosen either the flash or the zoom range, higher low or lower low to fib. And once that occurs, we get something that looks like this, right? This is your, what we call a smaller delivery. So this is the first one we fib. The second one is we fib from the very low and we fib that up. Let me just get into a reversal retracement. We fib that up, and I'm going to talk more about how this is anchored, because it's going to seemingly look like this is anchored to some random point in mid-air here, right? But believe me, on Wednesday, once we get into this more into the market maker models, that you're going to understand why I fibbed it that way and why it is that way. So in this case, the second delivery or the larger delivery, we have something that looks like that. And now we're monitoring two different deliveries for in order to see where price can head towards. Now what I will tell you guys here is that if you study Dexter enough, between the 1 to 1.5 standard deviation, can you guys tell me what you want to see occur between 1 to 1.5 standard deviations? Any of you? because this is what a perfect delivery would look like. And then we want to know what you see between 2 to 2.5 standard deviations. Right, so at 1 to 1.5 standard deviations, how are you saying retracement, Boomer? At 1 to 1.5 deviation, right? He calls it a silver bullet zone. I saved that for the second consolidation, right? So let's stick with retracement, or better yet, let's stick with the word consolidation. Okay, 5 Limbs Media has got that one on point. So you want to see in the ideal delivery, you want to see a consolidation low being put in, right? Whatever that low is, a low here between 1 to 1.5, and the ideal delivery will come back, tag that low, and continue higher to 2 to 2.5 standard deviations, right? At 2 to 2.5 standard deviations, what we know from Dexter or using these fibs is that at 2 to 2.5 standard deviations, we're gonna find either a retracement back to 1 to 1.5 or the OB, right? So something that looks like that, or we're going to find a full-on reversal that looks like that, and then comes and takes out the lows here, right? So at 1 to 1.5, we want some sort of consolidation. 2 to 2.5, we're looking for either retracement and or reversal. And if we expect higher pricing, then after we've retraced from the 2 to 2.5 standard deviation, where do we punt for or go to next? We look for 4 standard deviations, right? Everyone on board with that? Now, in the perfect delivery, what would happen is, if I put in a consolidation inside the 1 to 1.5, you're seeing it slightly off the 1 to 1.5 in this case right here, but it doesn't negate the fact that the consolidation low at this point is the candles that tapped into the 1 to 1.5. We can call it down here. In an ideal world, this should have tagged this low, then delivered to 2 to 2.5. At 2 to 2.5, we didn't quite have any unfinished business, so to speak, all the way down there. We could have come back into consolidation at 1 to 1.5, and then delivered to 4 standard deviations, right? So this is a perfect world where we tag the 1 to 1.5 consolidation low in this case. We then move to 2 to 2.5. We get retracement back to 1 to 1.5, and then we go higher. The fact that we didn't get that at 1 to 1.5, when we get to 2, it's not random that at 2 standard deviations, or 2 to 2.5 right here, when price starts to shift, we find that it goes for specifically that low right there. Let me just get that a bit more on point there, right? Because this consolidation low must be tagged on the way up in order for the delivery to push higher. So going forward, every one of you are going to be watching what happens, or what should happen, between the 1 to 1.5 standard deviation zone, whether we get a tag of the consolidation low, in this case in a market maker buy model, what's going on at 2 to 2.5 standard deviations. Is there a need to come back to the OB after tagging 2 to 2.5 standard deviations? In this case, there's your OB range down here, right? See that? Tags OB, and then we F off to 4 standard deviations there. So in your ideal delivery, like I said, consolidation at 1 to 1.5, tag a low, go to 2 to 2.5. Arrows appear off screen. Let me have a look at why that's happening. Sorry. Just give me a sec there. I'll fix that up. Give me 1 sec. My dumb ass didn't set this quite well. Right, that should be, is that a bit better now? Just let me know in a few seconds. Hopefully the OBS adjusts as I move. We'll give it a few seconds to see if the adjustment has taken place. There you go. It's good, right? Sorry about that. So again, ideal situation, 1 to 1.5. We create a consolidation low. We go to 2 to 2.5. We should have tagged the low at the 1 to 1.5 consolidation, then gone to 2. 2 has a retracement. Then we pump up to 4, right? So again, it's not random that we come down to this low of the 1 to 1.5 consolidation here. The lows inside here. And also the OB range before delivering to 4 standard deviations. Now the way this is set up is if we deliver to 4 standard deviations of this smaller delivery right here, the way that the bigger or the larger delivery is set up is that it also becomes 2 to 2.5 standard deviations of the larger delivery you're seeing on the left right there, right? Which means in this case right here, when we deliver to 2.5 here, we're tagging, before reversal, we're tagging almost 2 standard deviations of the larger delivery, and then we had a retracement to the OB range, right? So this is what we would use. We would use 2 different deliveries that are occurring on 2 different time frames, and I'm going to chat to you about what those time frames are. And you can see here, after tagging 2 to 2.5 standard deviations down here, back at the OB model, tagging the 1 to 1.5 consolidation low, it delivers to 4 standard deviations at the top here, almost to the tick, right there. Right? Like, if I adjusted it enough right here, if I adjust it correctly, what did this high come in at? $126,208.50, right? So we were about $8 off there. Now, understanding that inside these deviations or deliveries, that inside a market maker model, any market maker model, in a buy model, we also have a sell model, right? And inside the buy model, after the sell model completes, we have another buy model until the delivery has reached its terminus. So at this point right here, when I start to see a flash or zoom setup occur inside there, it means I can most likely do a fib right here of either the flash or the zoom. Now it's not too clear on this 243 time frame. Maybe I'll switch a couple time frames down so we can get something a bit clearer. We could go something that looks like this, right? Because at this point, this was the accumulation or a failure swing before the OLR occurred, before we started to deliver down. Now remember, in a market maker model, what does your ideal market maker model look like? Because you're going to start wanting to see certain things occur. like in the ideal market maker sell model, we have the sell model confirmed, low risk entry, first stage of accumulation, second stage of accumulation, which is a silver bullet zone, and then we deliver with speed to target, right? So you want to see these sort of consolidations occur in your FUB deliveries as they headed lower. So in this case, we have that delivery, and then we also have a larger delivery in play as well, right there. But in this case, right here, if I FUB'd these two deliveries on those time frames, we see that we had a first stage of accumulation right here. And again, you're looking to fade these moves as close to a consolidation high as possible, right? I'm going to show you what you can use specifically. We have a second stage of accumulation here. There's a high getting tagged, and then we reverse, and then we deliver to terminus, and lo and behold, that terminus range is now at 2 to 2.5 standard deviations. What does that mean? It means that this delivery has reached a possible reversal level, right? Reversal or retracement, that's what it means. So at this point, we can now look for, if this delivery has completed, we can look for a reversal out of here to take us to the larger delivery, which delivers at 4 standard deviations. Just going to pause a bit there so you guys can catch up. If everyone's good, you can just give me one in the chat, just so I know all of you are following. So far, we're talking about 2 different deliveries occurring. One will be a smaller delivery, one will be a larger delivery. We're looking at specific things to occur in those deviations. Where we enter becomes very important. What we expect becomes very important. So you see here now, when we came down back to the OB on the retracement of this standard deviation level, we start to push up with speed to 4 standard deviations to complete that delivery. Now look at what happened at the top when that delivery did complete, right? Again, accumulation, failure swing, OLR, CSD, retracement, expansion. Look at where this expanded to on the larger delivery and the smaller delivery. The end of this delivery was actually down here. So what that means is at 4 standard deviations, anything that goes past that, right? Let's look at that. Zoom in there. Let's get rid of these, not needed. Now this is not a typical delivery. Why? One thing I've also done is measure that leg we just ran up and see 50% and 70% in relation. Yeah, so we can talk about something like that. You're looking at an OTE entry of 50% for your entry. That's perfectly fine. I have a complete system. I actually have a complete indicator right here. It's called the Destroyer of Walls, and what this actually is when you saw me talk about my FTE course on WOP, that's still available if any of you want to go and talk about that. That is called the peak of understanding OB logic. So the FTE OB, or the failure to expand OBs, what we've done is we've come in and added some automation to it to automatically identify, right, OBs in the direction of trend, draw out a dealing range. So in this case right here, on this time frame, when it detects a an FTEOB, you can see here that from this high to this low, it created a dealing range, and the dealing range stops when 50% is tagged. So in here, right there, it tags 50%, and what we deliver to is 0.5 on the other end. Right, but this indicator, obviously, it's doing this automatically. So on this leg down here, there's a high. We didn't have any retracements back to 50% here until this point where we start retracing to 50%. From this point here, we're looking for OTE, which is right here. If time frame was not an issue right here, you would set an entry at OTE, probably put a stop above 887 or the highs, and we would look to deliver to 0.5 down here. You can see that it marks it off for you down here. 0.5 standard deviations on the other end, and what we end up getting here is there's your delivery right there. But we also end up getting a second delivery coming in here, right? So this is one. There's the dealing range right here. There's the low getting put in there. Here's a OTE entry right there. Same stop, and you can go for 0.5 on the other end. On this one is down there. Same premise, same idea. Right? So what this is actually doing is it's automatically drawing out your dealing ranges, showing you where the dealing range has completed, when 50% of the dealing range has been tagged, and it's telling you where to TP at 0.5 standard deviations beyond the dealing range. Now, once you start getting into things like this, on any time frame that you use, this is an 81-minute specifically, but I mean, you could go down to any sort of time frame, and this will start to give you things that look like this, right? Here tags OTE almost exactly, delivers to 0.5 on the other side. Here, retracement tags 0.5. Here, retracement tags 0.5, so on and so forth, right? Here, 0.5, 0.5, didn't deliver yet, but the idea would be coming all the way down here, right? But I digress on this. This is just something we did based on FTE. With dealing range automation. Right. Let's get back on track. Like I said, if any of you guys are interested in that, the course is available. It's a once-off purchase. I think you do get 1 month's worth of mentorship when you do purchase that. So if you want to take advantage of that, by all means, go for it. So down here now, we had, again, 2 different deliveries. One was right here. The second one right here. And I think what we ended up getting was somewhere there, right? You can see how we tag 4 standard deviations, and then this just fucks off the other way. Now, when you look at this kind of delivery that happened inside here, right? It's clear or apparent that not a delivery that you would look for, because your ideal or standard delivery in a market maker sell model would be what? You'd have a first stage of consolidation, you'd have some sort of second stage coming in here, right? And then you would deliver to the target. But in cases like this, where you don't have that, this all becomes the second stage potentially right here in this model. From this low to that high, we've now tagged that high. So there's a real possibility that if the model has to complete, that we had deep retracement on the second consolidation, that we run the low down here, and then we look at a possibility of any reversals. If you want to look at what that looks like, if we head over to NQ today, then we go down a few time frames. I had this, am I dreaming? I posted this in my Discord. Just give me a second. I think it was at this point right here. We had two consolidations inside here. One was deep. It pulled back down here, and then we just reversed out of there. Now I had two entries on NQ today, and if you look at why I had those entries, is you'll see, let's just do something like that, do something like that. These are the two deliveries I expected to occur today, right? First delivery out the bat comes to 2 to 2.5 standard deviations here. I expected or wanted a pullback to the OB range, so my entry came in at, again, flash range 50%. Here's the OB right here. As it hit 50%, that's where I entered here, and I expected this to deliver higher, but at 4 standard deviations right here is when I closed all of these trades out right there. I closed it out there. The second entry I went for was, if this was delivering higher to 4 standard deviations and this was a consolidation low, when we swept the low right here, I entered in here and held it to 4 standard deviations right there. Now, what I've been tracking and what I wanted to talk to you more about in this is what I wanted to talk to you about here is not even so much the standard deviations, because I'll break that down on Wednesday, how it's plotted and why. I wanted to talk about the idea that when you look at price, most of you don't understand that there's like, look at me fibbing the two deliveries here and having an expectation of where NQ should want to go to, right? Now that's about 27.2 over there, because the idea is based that we completed a 5-day delivery here and the character of the chart changed here, so we fibbed 2 deliveries to the upside right here, and here 2 to 2.5 standard deviations, we got a bit of a pullback. But all I'm looking for here is that price doesn't just willy-nilly go from, you guys have heard people say internal range liquidity, external range liquidity, all of that mambo jumbo. What does it even mean? When you want to use a system like this, it involves let's see if I have it on this chart or the other. It's likely on this chart. Right. It involves having to understand that price will, in a consolidation, will not just move from internal to external without completing all of the unfinished business. So on Friday, let's have a look at before Friday occurred, right? what I'm talking to you about here is that when we have a 5-day delivery or 2-day delivery or daily delivery that's starting or occurring, price will move from a daily delivery like this, and at the first consolidation we'll have a consolidation, we'll move up, we'll move up, we'll move up, and we'll do something like that, right? So what this means is that in this first leg from here to here, if we had a daily delivery, then my first time frame of choice is the 7:29 minute. Going down is a 2:43, 81, 27, then 9, then 3, then 1, and then 15 second, right? That's the sequence that I follow. Now, this is not my body of work. I actually have guys in my Discord who have actually perfected this stuff, so they are much more knowledgeable on this delivery. There's 1 or 2 guys in there, but what I'm taking out for you is the simplest way to understand and use this delivery system or method of understanding where liquidity is and where price should head to first before you have any expectations of expansion or those are all Fibonacci based numbers, all based on Fibonacci. So when we understand that, what we're looking for is, and I'm going to try and make this look simple and nice for you guys, since I already have the markings made out here. Let me get rid of this, and let me get rid of this, right? At this point right here, the 729 created a 729 candle high or external liquidity. Down here, if I go on a 729, you're going to see at that point there's your 729 high being created here. Below it is a 729 FEG right here. So what does price do? It moves from external range liquidity on a 729 to internal range liquidity, and that is this low or this FEG on a 729. And after delivering internally to a 729 FEG, it moves externally right here to this 729 liquidity right there, and afterwards it starts to move lower internally here. 729 CE or volume imbalance delivers externally on a 729, and then comes all the way back down here for a 729 volume imbalance before this explosion occurs, right? Which means on a 729 time frame, we've completed all of the business inside here. We then hop down 1 time frame lower on a 243 and do the same thing here. Price delivered to a 243 FEG here, then delivered externally, came down, delivered internally, delivered externally, came back down, volume imbalance on a 243, completed all the business inside here, then we exploded. Hop down to an 81, same story. Price will complete all of the business it needs. 81 volume imbalance, 81 wick CE, all of the business, everything on an 81 completed. Same on a 27, 9, 3, and the moment it completes on a 1 is when that explosion should occur, right? The moment everything completes on all of these time frames, we then start to see the explosion occur. We then go ahead into another consolidation, and I did the same thing here I did on Friday. Hop onto a 729, see what's going on at the highs right here. And what I found was here I had 729 external liquidity. I had a 729 wick CE inside here. 729 breaker block, 729 FEG, all of this on a 729. Do the same on a 243, 81, and so on and so forth. You'll see that price didn't move until this point where it tags. Let's just get the CE put up here for you guys before there's a 729 wick. Take the wick high to the wick low, find the EQ of that right there, come down to lower time frames. You're gonna see that the moment it tagged that 729 CE right there, it broke down. Once it broke down on a 729, you're going to look on a 243. What did it do on a 243? What did it need to do on a 243? On a 243, you have a wick CE here. On an 81, we have this high right here. We have OB right here. We have 81 rejection block up here. And when you start to bring this all the way down to a 9 minute, a 3 minute, and you find that they've completed all of the deliveries that they needed to, right to here, we had an M3 CSD here, MSS here, retracement to consolidation highs right here, and then price again falls off a cliff. So the idea is that even today, right? Even today, or even that day, right here, I took a short here, all the way down here, because it tagged an 81 CE wick. I shorted here down to a 243 OB. From here, I wanted price to head up. It tags an 81 OB inside here. It reverses. Before it goes up, I longed right here when price tagged. Let me just show you the 27 time frame CE right here. So because I'm marking all of these out, it ended up being something like that, and to the 81 OB right there. This was the trade, the long that I took. Took a short here, down here. Now, when price pulled back in here, I wanted to short this because we tagged the 81 OB. I wanted this to deliver to the previous day's low. Instead, it delivered at the open, delivered high up here to the 729 CE. Then we had the breakdown, and then price moved. Now, I think it just took me out here somewhere before it moved down. I wasn't too upset because I didn't quite expect this move down here. But afterward, once it broke here, this is when I took this short and I took that short right there. Come back to today, and what are we seeing here? Market opens up. We have a devil's mark at the open. Price just effing off much higher. So what am I marking off here? 243 FEG, 27 CE, 243 CE, 729 external liquidity, highs right here. So at this point right here, I didn't long at the market open. I posted a chart that this should come at the 243 CE, come down here, and then deliver up here, right? But I didn't take it on the first push down because that's inducement. I waited for it to come here, and that was my first long. And if you want to understand what's happening on the lower time frames and why things end where they end, then what we can do for you is something like this, right? We can take one delivery right here. Again, put your standard deviations on. And this is how I mostly get to play all swings, right? Right there. And the second one right there. You can see that the way the bottom was 3 to 3.5, 4 standard deviations here, 2 to 2.5 standard deviations there. We can expect something to occur there. This is why I took the long right here. On this time frame, we had a 1 to 1.5 standard deviation consolidation low right there. If you see it right here, the low of that consolidation was not tagged. Randomly they come back down, they tag it, and they run the other way, but there's still unfinished business below, standard deviation wise, PDRA wise, M3, M1, all of that. Come down, then reverse. It's the same things over and over and over again. Like, you could do this, 2 to 2.5 standard deviations, you expect retracement or reversal. You could do, this is fibbing only one delivery. You could come in here, we could fib a second delivery down here. Look at this, that's one delivery right there. 4 standard deviations, random. 1 to 1.5 standard deviations, where's the high? That candle's high, most likely right there. Comes back for it, probably starts to move. At 4 standard deviations of the smaller delivery, we then have a larger delivery occurring inside here like that, which means there's a likelihood that we go from here, if you're bearish, to down here to complete that delivery. Is this starting to fit into or fill in some of the blank or missing pieces into most of your guys trading? There's hours and hours of videos on and inside the Discord WAP section that explains all of this in detail. Let's give me some feedback. Since there is a 20-second delay, then we can continue. We need to start rounding things up now. You guys have any questions? Can you see what I'm talking about here? There's things that have to happen in a delivery, in a specific you don't use them for targets only. You use them, what we're doing here is past using them just for targets. We're using them to understand and navigate the entire delivery, because there's certain things that need to occur, should occur in these deliveries, right? I haven't shown you how to plot them. I'll do that on Wednesday. But trust me, you've never seen anyone in the space use dual fibs before. And that's because deliveries are not occurring in a singularity on their own. When a time frame is delivering anything, it's delivering a smaller time frame and a higher time frame at the same time. So a daily time frame here, delivering up here like this, inside a daily time frame on the lower time frame it's delivering a 729 inside here. And then when you have a consolidation or retracement, it starts delivering a 243 and then an 81 inside here, and then a 27 and then a 9, a 3 and a 1 to complete. So there's multiple time frames. What we actually call it is Russian dolls, because there's time frames within time frames within time frames. I haven't used the 243 in open high low close stat map. Not yet. Not yet. But you guys were under the impression that price should just hit something and then just move, but it doesn't work that way, because clearly when the time frames don't have unfinished business or don't line up, then those explosions or moves that you expect to occur don't or won't happen. They won't. You could go and take any market maker model. On Wednesday you'll see, once I'm done with showing you how this works, you can go and take any market maker model that you find, right? And the best way to actually use a standard deviation is every time price hits one of these EMAs and gives you a flash model or a zoom model, you fucking fib that. You just fib that and then send it. Because what happens is, once we hit an EMA and then we get either a flash or a zoom, and when we start to fib that, we have expectations that one delivery starts here, a second delivery is going to start somewhere on this time frame, delivering higher, right? And inside here, 1 to 1.5 standard deviation zones. Let's just put this off for a second. If this is the 2 time frames or deliveries that we expected here, then 1 to 1.5, we see a consolidation low, get tagged. The higher delivery, 1 to 1.5, consolidation gets tagged, delivers to 4, pulls back, delivers to 4 up here. Everything above here is sort of a deviation to where this delivery should have ended right there. Now the moment you get a flash or a zoom showing up here, you start to do the opposite in the other direction. You take the flash range down there, and that's a smaller delivery. Then you take a larger delivery somewhere down there, and lo and behold, you see that right there. Again, 1 to 1.5 standard deviations, consolidation high, you want to see a tag. 1 to 1.5, here's your tag coming in here. There's your delivery to 2 to 2.5. Retracement back to 1 to 1.5, delivery to 4. Which means we can have some expectation that in this delivery, something completed here, until we start a new delivery somewhere in here to get us all the way down here. No, we don't have an indicator for flash or zoom. Flash or zoom is something you just need to be able to identify. There was a point where and there probably still is a point where I want to automate flash or zoom. Maybe we'll have a talk with the guys at 2 degrees, because none of this is really automated as such at the moment. But the understanding is clear, and on Wednesday it'll be even more clearer, that nothing begins or ends without a flash or a zoom model occurring. And once you get a flash or zoom model, anything that falls within that delivery from the beginning to the end should not give you any kind of market structure shifts, only trapping sellers in this case and then moving higher until the objective is met. That objective is going to be dictated by standard deviations that we use, and from there we make other decisions on what's going on next. Tie those in with all of the liquidity based on all of the different time frames. Like for me here, tagging a 729 high, let's just switch all of these off. Tagging a 729 candle high here, I got to be on my toes, because once this candle ends, there's a likelihood that the next 729 candle, after delivering externally here, is going to want to deliver internally, and that could be all the way fucking down here to this devil's mark right here, or even that's the weekly open, or this volume imbalance, or that rejection block, something internally. It could even come back to the CE of this wick right here, do something else internally, or tag this one more time, then push lower. So price tagging a 729 CE for high for me there was where I get the hell out of that equation. Not interested in stuff like that anymore. So this is the second half of Wednesday's stream. It's recorded, you guys can go back and watch it later. On Wednesday we're going to chat more specifically on the standard deviation fibs and how I actually fib them and use them. Right, I'll take a few more questions before we wrap this up. Yeah, it's not, Kaiser, it's just not just about finding an OLR or a manipulation leg and then fibbing it, because once you start to bring the EMAs into play, right? There's a whole bunch of different EMAs. You can see that price starts to switch gears with these EMAs. Like here's an EMA cross here, and then price just switches gears and start using these smaller EMAs to deliver. It's the same as on that huge delivery down, a gear where my shorts occurred here, price switched gears and started using the smaller EMAs, and that's how you know that shit's going down right here. Started using the smaller EMAs and then just started, you can see here, every time it actually touches one of these, you just fucking short. The EMAs, again, same Fibonacci numbers, Divakar. If you go in, find an EMA indicator, you can go 15 second, 139, 27, 81, and 243. You can even go, I'm missing a time frame, 729. Yeah, there's that indicator that I was actually telling you about. Sorry, the drawings, the EMA that I was telling you about at 24,404. Right, if you zoom out here on a slightly higher time frame, yeah, we're making EMAs cool again, Expo. There's that EMA down here. So you manipulate an EMA, you find a zoom or flush, you project that shit up, you tag an EMA, you tag an EMA, you tag an EMA. These should reject. And in the grand scheme of things, you look here, how these deliver, every time we tag an EMA, we move. We tag an EMA, we move. We tag an EMA, we create a zoom or a flash model, we move. Move, move, move. That's, I think, that's one of the keys to not just fibbing any random OLR flash or zoom. Just find an EMA indicator. I'm not even sure about this one. Find an EMA indicator, put all of these Fibonacci timeframes onto them, and give it a go. See what comes off of it. Be specific into where you're hunting liquidity internally and externally with this model. I never wanted to myself until, like, this is nothing, because each of these EMAs is actually assigned to a time frame, and if you understand what time frame EMA is being delivered, then you understand where your CSD should occur, or which time frame or EMA that CSD should occur on, if that makes sense. Because think about something here. We tagged this EMA here, we created a zoom model here, right? Which could basically fucking mean that whatever's going on with NQ right here, that in all likelihood, that could be the next delivery down on a smaller time frame, and on one larger time frame, it could be a delivery like that. Which means this daily open we had here today is not necessarily safe, but we need, there's no CSD here yet, but the moment this starts to close below this low at 1501 and creates that MSS, we have the CSD, we have the low risk entry consolidation showing up here. We'll look for consolidations here, deliver here, pull back here, and then finally deliver down here. Yeah, you can do that, Divaka. You can do that. All right. So again, if you guys need anything, you know where to catch me in my Discord, on Twitter or wherever. And to those that are watching, I will see you guys on Wednesday inside the 2 Degrees live. I have included, I think in this stream is a 25% discount on anything, any mentorship from me. I think it's a 25% discount. If you guys, some of my old guys are here, if you're looking to come back, you can use the code POISON. Right? If you are looking for more precision, then yeah, just use that code right there. That should get you 25% off on the mentorship and access to all of the videos and all of that inside. Yeah. It's you know, when you understand why or where speed and a breakaway gap occurs or should occur, which I teach in the group. It's actually in my price action course, it's a whole video. It's a specific occurrence for speed and a breakaway gap to occur, right? It's a point in price or in time where there are candles that have taken liquidity, highs or lows, and there is no liquidity left above them, is when speed should be created. Because once you move above a high that has taken, like if you look at this wick right here, took this candle's high right here, there's no liquidity above this wick, which means price should want to speed through this high and look for liquidity to the left that's higher. This is when a breakaway gap should occur. You trade the bag, and that's it. Okay, I gotta run here. I'm actually not at my own desk, so I will catch you guys on Twitter. Use the code POISZN, POISZN. It will be in the detailed description on the YouTube description here for this video once it's loaded, and that'll get you a 25% discount. And I will see you on Wednesday for technically part 1 of what this call is going to be using standard deviations. See you guys later. You too, Tony. You too. Cheers. Bye. Bye.